July might technically have been summer, but it was definitely very busy. A lot of that had to do with the run up to the announcement of the US Section 301 tariffs. Everybody was very nervous. People sort of knew what was coming, but since nothing had been announced, there was always that gray area that kept everybody on the edge of their seats, so to speak. And also because I think this year got off to a really slow start. It seemed to only gain momentum as we got into Q2. I don't know if it's just me who sees it that way, but I certainly felt that the year started off slowly and then finally picked up steam. Now, as we head into August, we're looking at where the industry stands with regard to what's happening upstream in sourcing and supply chain, and of course, what we're seeing happening downstream at retail with consumer demand, particularly as we're heading into the back half of the year, which is that critical, all important back to school and then holiday seemingly stretching from mid-September right through to the end of December. So let's first start off with looking at what we see happening upstream in sourcing. Now, tariffs, the Section 301 tariffs have added another layer of complexity to sourcing, but at least we know what they are. And so again, we're very happy to know where we stand. At least we're not waiting for that next shoe to drop, so to speak. They're officially in effect as of the end of July, but unlike past tariff rounds, this is not a clean, flat rate. It's two tiers, first of all. Certain countries got 10%, for example, Canada, Mexico, India, Indonesia, UK, and others. And then about 43 other countries got 12.5%. And in terms of the key sourcing countries, Vietnam, China, Thailand, Philippines, and Turkey all got hit with that 12.5% tariff. However, the real story are the exemptions. Now, they're being granted by specific HTS code, not by country or category. So that means that brands are going to have to check the exact 10-digit HTS code and look for a matching Chapter 99 exemption. So that's going to be something that we're watching. There's also exemptions that generally track to the USMCA trade agreement, the DR-CAFTA, and reciprocal trade agreements with the UK, the EU, Malaysia, Cambodia, Guatemala, others. I mean, there's a lot of stuff going on around. You really do need to speak to someone who's a customs expert in order to sort out a lot of the fine points on this, which is not really ideal in an already complex supply chain and sourcing environment, but it is what it is. There's also coming next TRQs, right? The tariff rate quotas, which will be coming through for Bangladesh and Cambodia, Indonesia, and Malaysia, tied to certain volumes, right, of textiles and apparel that could be tariff exempt, tied to how much U.S. inputs are used, right, in making those particular products that will be then exported back to the U.S. So details are still being finalized, but obviously the key thing is to incentivize manufacturers to be using U.S. inputs. I mean, the big picture really is that it's not a blanket apparel exemption policy. It's a bargaining tool to reward countries that are cracking down on forced labor and supply chains and that are using more U.S. inputs. Now, when we look at materials, that's another interesting thing because we're seeing a divergence in materials prices. On the one hand, natural fiber prices are going up and continue to remain elevated, whereas synthetic fiber prices have leveled off. Natural fiber prices, if you look at cotton, moderately bullish, whereas cotton prices had been pretty weak for a while. Now they're trading around 80 cents per pound. I mean, that's at the time of this recording. Could be different when you're listening to this. The USDA sees prices rebounding towards 90 cents per pound in 26-27, which they say is being driven by low global ending stocks. Now, again, that could change. There's a lot of issues around supply and demand, but still cotton for the moment is being seen as being moderately bullish. Wool is like a house on fire. Wool has not found a ceiling. Prices are firm to higher, being driven basically by demand for fine and superfine merino. There's tremendously tight supply in Australia due to drought and the fact that flock rebuilding has been slow. But also there's a very big demand coming primarily from China and Europe that sees wool as part of a premiumization picture, but also part of a sustainability picture. Now, that's also part of what's happening in linen. Now, linen, of course, is not quite as high priced or in short supply as wool. And certainly what's helped linen or helped people who are buying linen is that there's been record flax production. So that's eased supply scarcity. However, demand for apparel grade linen has surged about 15% because consumers and brands are shifting more towards, again, sustainable fibers, part of being able to meet compliance regulations, specifically from the EU, that are demanding more sustainable apparel. And one of the easiest ways to do it is by using natural fibers. So that's been a real boost for linen. And linen is also seen as part of that premiumization drive. Now, synthetic fibers, if you're looking at polyester, nylon, spandex, largely stable to somewhat drifting downwards. There's certainly ample capacity, particularly in China. Demand is improving, downstream demand, but it's been a gradual improvement. So yeah, there's still pressure on synthetic fiber prices, particularly in light of leveling off of oil prices. But acrylic yarn is the outlier in that. Acrylic yarn is getting a boost by the fact that wool, right, has gone so expensive. So therefore, you're seeing a lot of fiber substitution. Being brands who are either taking what used to be 100% wool and now it's a wool acrylic blend, or moving completely into acrylic as, like I say, a fiber substitute. So acrylic yarn is definitely benefiting from that. Prices are being supported. Oil remains the wild card. Major oil agencies worldwide, the people who are watching oil because it's a key commodity, still feel that oil prices are going to be lower by the end of the year, still see oil around pre-war prices, still say that there's a glut worldwide. But at the same time, the situation around Hormuz is anything but stable. And so there's always that certain amount of volatility that is still supporting oil prices and creating that little bit of we're not sure. So I think that as we look ahead, based on what a lot of these agencies are predicting, is there will be volatility around oil, but nobody right now is expecting oil prices to be up around $100 per barrel or $90 per barrel, more than just the occasional spike, during day trading or maybe a 1 or 2 day spike, but not something that's really going to move industry prices. So that's the vision right now. Again, I am not an oil commodities trader, but there's enough people watching this and predicting that we feel pretty confident that oil is not going to be a huge issue. Logistics, of course, have been costing people a lot. Certainly, freight rates have gone really, really high. A lot of that was driven by an early peak season, which now looks to be past. So certainly we're seeing freight rates drifting downwards, but still well above year-ago rates. Part of that is higher oil costs. Certainly, we could see a big downturn in freight rates going forward. There's a tremendous amount of new vessel capacity that's going to be coming through 2028. So therefore, capacity could outpace demand. However, carriers have gotten quite clever at being able to control the capacity that they put into the market. But for now, rates we expect to be continuing to drift downwards, but nobody's expecting them to sort of fall through the floor. So if we zoom out on the supply chain side of things for August, the market reaction to the new tariffs has been fairly muted. Arguably, we see tariff fatigue after years of living with them. So people sort of knew it was coming. A bigger issue, most likely, right now is trying to comply with EU sustainability regulations for those brands that are importing into the EU. It's a big stress point right now. They're not dealing with tariffs, but you could say that the new EU regulations are far more complicated in order to be able to comply with. And most brands say they're not ready. They need years, not months, to be able to build out the data infrastructure that's going to be necessary to manage all that incoming data and to be able to integrate it and analyze it such that they can prove that they are complying with these regulations. It's not easy. Now, of course, a lot of conversations have come up around using AI to be able to cope with that. However, nobody's 100% sure as to which of these systems is the right system for their company. So before investing a lot of CapEx into something, people want to understand, well, what are my options? What's the right one for me? And what are the risks around it? I mean, when we talk about AI, we're usually thinking about it in terms of how we use AI, which is, ChatGPT or Claude or Perplexity on our desktop. It's a little bit different when it's being deployed at an enterprise level. AI could potentially provide a solution, but we're not at the point where brands are ready to go full steam ahead with that. Overall, we see that brands are running lean. The market has proven to be better than expected, but everybody is really erring still on the side of caution. And when you look at import figures, imports into the US from January through May were down 9.1% year on year. And into the EU from Jan to April, which is the most recent figures we have, down 10% year on year. So really what we're looking at is that brands and retailers are very deliberately keeping inventories low. Nobody wants to get caught with overstock. And at the same time, there's a lot of incentive in order to protect full price selling. And it's really hard to sell at full price when you've got an inventory buildup in your warehouse that you need to move. So all of that is really pushing towards smaller orders, more frequent orders, inventories low, and a scenario that's really leaning in towards caution. Now, if we look downstream at what we see happening at retail and consumer demand, again, we see a picture that's better than expected. US and EU retail spending is holding fairly steady heading into fall. Not a growth market, but not falling apart either. Consumer spending has actually beat expectations in Q2 in both markets. US up 3.2% year on year. Europe up 0.4% quarter on quarter, fastest growth since Q1 2025. Back to school so far has been flat, according to Deloitte. We're only looking at July sales because obviously we're recording this at the very beginning of August. Holiday outlook remains cautiously optimistic, but with the emphasis realistically on caution. Again, nobody is predicting big growth. Most of the growth outlooks that we're seeing from the major banks for these two markets is really single digit growth. So growth, which is better than nothing, but not tremendous growth. However, it's not the narrative that a lot of the headlines say, where they're talking about consumers who are barely able to put food on the table. It's a consumer that's cautious, but a consumer that's still spending. Really what it comes down to is not whether they're spending, but what they're actually choosing to spend money on. So we are seeing some areas where spending is still quite good and other areas where it's tough. Economists, continue to point to what they call a K-shaped economy. So wealthier consumers still spending freely, but the broad-based consumer market remaining cautious. The key thing is really brands shifting away from that automatic lean into discounting to trying to have discipline and restraint, fewer products, lean into full price sales, as opposed to just having tons and tons of assortment and then everything end up being sold at a discount. So I think that's a very big shift that we see happening in the market. And of course, it's not easy to do when you've been doing things a certain way for a long time. But we do see brands that are doing that effectively. Next in the UK has been doing that for a number of seasons. Levi's is talking about doing that a lot, and certainly we're seeing a lot of that more sharper strategic focus coming through. For example, their recent Q2 earnings report showed net revenue up 8%, net income up 19%. And increasingly, we're seeing brands that are now maybe not actually achieving the results yet, but the direction is towards, let's get rid of all the extra products that we have. Let's get rid of brands in our portfolio that are not really supporting our DNA. Let's become leaner and more focused. So I think that's an important direction that we see coming through. Maybe not seeing the actual results yet, but coming through. So if we want to summarize where we are heading into August, essentially sourcing teams are really dealing with more complexity, not necessarily more cost, but certainly more complexity. Spending is holding up at the consumer level. However, it is a bit subdued. Nonetheless, we are seeing that consumers are willing to spend. The brands that are turning that consumer resilience into real earnings are the ones that are applying discipline. Um, we're seeing that more brands, as we discussed, are trying to run leaner and meaner. They're trying to reduce the number of SKUs. They're trying to weed out some of their brand portfolio to make sure that what they have is really tightly focused. And we're seeing a commitment to trying to sell more at full price rather than just simply chasing growth for the sake of growth. If you're looking for insights on what we see as some of the biggest growth categories coming forward for apparel, you'll find some of that on our website at insidefashionlive.com, as well as brand analysis and, of course, a more comprehensive look at what we see happening in sourcing and supply chain. Thank you for being with me here, and I will see you again next month.